All right, let's dive into the Indian stock market today.
Sounds good.
We've got some interesting sources to dig into.
Yeah, what are we looking at?
We've got, first up, this market analysis.
Okay.
And the headline is Screaming Market Red Alert.
Oh.
A little bit dramatic, don't you think?
Yeah, maybe a little bit.
And then we've got a financial newsletter from Volatility Coaches of India.
Okay, so like different perspectives, potentially.
Yeah, exactly. So let's try to make sense of all of this and see what we can learn.
Sounds good.
So starting with this market red alert analysis.
Okay.
It says, technically, markets are in ready and no sign of positivity as of now.
Mm-hmm.
This is as of January 28th, 2025.
Okay.
So pretty recent.
Yeah.
What do you make of that? I mean, it sounds kind of scary.
Well, it does sound alarming, but I think it's important to, not just stop at the headline and actually like read on.
Okay.
Because, often there's more to the story.
Right.
And actually, like right after that very dramatic statement, they say that valuations are slowly becoming attractive.
Oh, interesting.
So that kind of like softens the blow a little bit.
So it's not all doom and gloom.
Exactly.
There might be some opportunity here.
Yeah, so what does that mean? Like valuations are slowly becoming attractive. What that means is that, the prices of stocks might be getting a little bit more reasonable compared to, how much money the companies are actually making or their sort of true worth.
Hey.
So you can kind of think of it as like, finding a sale on something that you've wanted to buy, right?
Yeah,
like,
right.
oh, okay, the price is coming down.
So maybe it is a good time to buy.
Yeah, potentially. Yeah.
So a silver lining.
Makes
on the
this
break
lining, yeah.
in the red cloud.
Yeah, exactly.
Now, the analysis goes on to say that the only way the market can move north if government infuses liquidity into the market.
Okay.
So what does that mean?
So what they're basically saying is that the government might need to step in and do things to kind of boost the economy.
Okay.
And one way they can do that is by trying to increase the amount of money that's circulating, in the financial system.
Okay, so like stimulating the economy in a way.
Exactly, yeah.
Okay, and how would they do that?
So there's a few things they could do.
Okay.
One thing is they could reduce interest rates.
Okay.
Another thing is they could make investments, in infrastructure projects like building roads, bridges, that kind of thing.
Okay.
Or they could offer, tax breaks to businesses and all of these things.
Kind of encourage growth.
Exactly. Yeah. They're all sort of designed to kind of stimulate the economy.
Okay. So that's something to keep an eye on, potential government intervention.
Yeah, definitely.
But let's move on to our second source now.
Okay.
This weekly newsletter from the Volatility Coaches of India.
Okay.
And wow, this thing is packed with data.
Yeah, I was looking at this earlier.
There's a lot to take in.
Yeah. We've got PE ratios, PB ratios, MG, RSI, it's enough to make your head spin.
Yeah. It's a lot of acronyms for sure.
So maybe we should just focus on a few
good idea.
Key metrics that can give us, some insights into the market.
Yeah, definitely.
So how about we start with the PE ratio?
Sure. Yeah.
We hear about that one a lot, but, for our listeners who might not be as familiar with it, what is the PE ratio?
So the PE ratio stands for price to earnings ratio.
Okay.
And basically what it tells us is how much investors are willing to pay for each rupee of a company's earnings.
Okay, so if the PE ratio is high, does that mean investors are really optimistic about future growth?
Yeah, exactly. They're willing to pay more
because
they think the company's going to do really well in the future.
Okay.
And, on the flip side, if the PE ratio starts to decrease, that could be a sign that investors are becoming a little bit less confident about the company's future earnings.
And we actually see that in this newsletter. They're comparing the data from January 19th to January 26th.
Okay.
And we do see that the PE ratios have decreased a little bit.
Okay, so not necessarily like a super positive sign.
Yeah, not
something to kind of keep an eye on.
Exactly.
So what other numbers in all of this data should we be paying attention to?
I think another important one is the Nifty level.
Okay.
Have you heard of the Nifty?
Yeah.
So it's it's a benchmark index for the Indian stock market.
Okay.
Kind of like the Dow Jones in the U.S.
Yeah.
So it just kind of gives you a snapshot of how the overall market is doing.
Okay.
And in this newsletter, they show that the Nifty Y actually dipped slightly.
Okay.
From 23,203 on January 19th to 22,829 on January 26th.
Okay, so a slight dip in the Nifty along with those decreasing PE ratios.
Yeah.
Not exactly like screaming buy right now.
Not exactly, no.
Okay, but wait a second. There's something here about projected returns and the Buffett indicator.
Yeah.
Now that sounds intriguing.
Yeah, so this is where it gets, I think, really interesting because now we're starting to see, a bit of a different perspective on the market outlook.
Okay.
So this newsletter, they're using this thing called the Buffett indicator, and they're projecting a 6.2% annual return for the Indian stock market.
Okay, so a little bit more positive than that market red alert.
Yeah, exactly.
So tell me about this Buffett indicator.
So the Buffett indicator,
Yeah.
it's basically a way of comparing the total value of the stock market to the country's GDP.
Okay.
Which is, like a measure of its economic output.
Okay, so like how much is the entire country producing?
Exactly.
Okay, and so if the stock market value is way higher than the GDP, that's probably not a good sign.
Yeah, it could be a sign that the market is what they call overvalued.
Okay.
Right? Like it's kind of like a bubble that could potentially burst.
Right.
And then on the other hand, if the market value is, relatively low compared to GDP, that could be a sign that the market is undervalued.
Okay.
And that might present some good buying opportunities.
Okay. So it's all relative.
Exactly.
Okay. So the Buffett indicator is just one tool.
It's just one tool. Yeah.
To look at.
Yep, exactly.
But it's interesting that they're projecting this 6.2% return.
Yeah.
We've got market red alert flashing warning signs over here. But then this newsletter seems a little bit more optimistic.
Yeah.
Are these two viewpoints necessarily contradicting each other?
That's a really good question.
Yeah.
And I think it's important to remember that market analysis, it's not an exact science.
Right.
Right? Different analysts, they use different methods.
Yeah.
They might prioritize different factors. And so that can lead to, varying conclusions.
Yeah, that makes sense.
So, one person might see a red alert while another person might see an opportunity.
Right. And I guess it all depends on your perspective and what data you're looking at.
Exactly. Yeah.
Okay. So for the average listener, who's trying to follow all this, what does it all mean?
Well, I think it means that it's really important to understand those key indicators and trends.
Okay.
And it also means that it's really helpful to seek out diverse perspectives.
Okay.
Don't just listen to one person or read one article.
Yeah.
Try to get a range of views.
Yeah, get the full picture.
Exactly.
And then make your uninformed decisions.
Exactly.
Great. Okay. Well, speaking of different perspectives.
Yeah.
This newsletter, it doesn't shy away from giving specific investment advice.
Okay.
It says, below 23,000 Nifty level, convert all debt to equity.
Wow, that's pretty bold.
Yeah, I know, right?
Yeah.
And then it says, below 22,000 Nifty levels, buy more equity, even convert gold and FD to equity.
Wow, they're not holding back.
No.
They're very confident in their views.
Yeah. So, what do you think? That's pretty bold advice.
It's very bold advice. And I think it's important for, anyone who's reading this to remember that this is just one perspective.
Right.
And what works for one investor might not work for another.
Okay.
So I think it's really important to get, personalized financial advice, especially when you're making big decisions.
Okay.
Because blindly following, market tips can be very risky.
It's like anything else, right?
Yeah.
You need to do your research. You need to understand, what you're getting into.
Exactly.
And figure out if it's the right fit for you.
Yeah, absolutely.
So sound advice. But maybe take it with a grain of salt.
Yeah, definitely.
Okay, so let's explore some of the other recommendations in this newsletter.
Okay.
It talks about focusing on large cap funds and momentum funds.
Okay.
And it also highlights specific sectors like banking, finance, IT, and pharma.
Yeah, those seem to be their favorites.
Yeah.
They keep coming back to those.
Why might those areas be particularly attractive in the current market conditions?
So large cap funds.
Yeah.
They usually invest in companies that are, pretty well established.
Okay.
Financially stable.
Yeah.
So they can offer, some security in a market that maybe is a little bit volatile.
Okay.
And then momentum funds, what they do is they basically focus on stocks that are showing like a strong upward price trend.
Oh, okay.
So they're kind of, hoping to ride that momentum through, even higher returns.
Okay.
And then those sectors they highlight.
Yeah, banking, finance, IT, and pharma.
Yeah.
India's become like a global player in those areas.
Exactly.
Right.
Yeah.
So it makes sense that those would be attractive to investors.
Yeah, especially, the IT sector in India. I mean, it's experiencing really strong growth, driven by global demand for software, technology services.
Okay.
And then the pharmaceutical industry as well is really thriving, fueled by domestic demand and exports.
So it seems like they're picking sectors that are really kind of booming right now.
Yeah, exactly.
But, even though they're recommending those sectors,
I guess the question for the listener is, are the sectors actually relevant to your own investment goals?
Yeah, that's a great point.
Yeah.
I mean, just because a newsletter recommends something doesn't mean it's the right fit for everyone.
Right.
You really have to think about, your own individual needs.
Okay.
Do your own research. Think about whether those sectors align with your overall investment strategy.
Okay. So it's not just about following the latest tips.
Exactly.
It's about really understanding what you're investing in and why.
Exactly.
Okay, great. So we've covered a lot of ground here.
We've talked about red alerts, market indicators, investment advice.
Even the Buffett indicator.
Yeah. But this newsletter has even more to offer.
Yeah.
It actually provides a timeline of market trends spanning from 2022 to 2025.
Okay.
Showing periods of gains and losses.
Okay.
So it's kind of like a historical overview.
Yeah, interesting.
Of what's been happening in the market.
Yeah.
So for instance, they mentioned that around March 8th, 2022, a positive trend was emerging.
Okay.
And then they talk about a turning point around April 2023. So, what factors might be driving these shifts in the market?
Well, I think, these trends are likely influenced by a lot of different things, both within India and globally.
Okay.
So if you think back to 2022, the world was still dealing with the aftermath of the pandemic. There were supply chain issues, rising inflation, and all of these things likely played a role in that, initial downward trend that we saw in the Indian market.
Okay, so a lot of external factors.
A lot of external factors, yeah.
Kind of pushing things down.
Yeah, and then as 2022 progressed, India's economy, it started to show some signs of strength.
Okay.
And that might have led to, that more positive trend.
Right, so a little bit of hope starting to sprout.
Exactly, yeah.
Okay, and what about that turning point in April 2023?
Yeah, so it's hard to say for sure.
Yeah.
Without, more context from the newsletter. Yeah. But it's possible that, global events, things like, changes in monetary policy by major central banks or, geopolitical tensions, fluctuations in commodity prices, all of these things could have influenced that shift.
Yeah, it seems like the market is constantly reacting to events.
It is, yeah.
Both big and small.
Exactly, yeah.
Okay. Now, speaking of interesting trends, the newsletter ends by saying, Nifty Small Cap 100 remains positive. Nifty Mid Cap 150 also remains positive.
Oh, interesting.
So this seems to contradict that initial market red alert.
Yeah.
Why might these segments of the market be performing differently from the overall market?
That's a great question.
Yeah.
So small cap and mid cap stocks, they often represent companies that are kind of still in their early stages of growth.
Okay.
Right?
Yeah.
So they tend to be a bit more volatile than larger companies.
Yeah.
But they also have the potential for, much greater returns.
Okay. So they're a little bit riskier.
They can be. Yeah.
But they also have higher potential.
Potentially, yeah.
Okay. So what does this mean for the listener? Should they jump on the small cap and mid cap bandwagon?
That's a good question.
Yeah.
And I think, as always, it depends on their, individual circumstances and risk tolerance.
Okay.
So investing in these smaller companies, it can offer, that potential for higher growth, but it also comes with, more volatility and more risk. So you have to really research thoroughly, understand the companies that you're investing in, and consider if that level of risk is right for you.
Okay, so do your due diligence.
Exactly.
Okay, great. Well, it seems like we've reached the end of part 1 of our deep dive.
Already.
I know, right? Time flies when you're talking about the stock market.
It does.
But we've covered a lot of ground.
Yeah, we have.
We've got more to explore, though.
I know. I'm excited to see what else is in this newsletter.
Me too.
Yeah.
So we'll be back soon to continue unraveling all these insights.
Sounds good.
And help you navigate the exciting world of the Indian stock market.
I can't wait.
All right. Okay, so we're back, and we're still digging into this newsletter from Volatility Coaches of India.
Yeah, this thing is packed with information.
Yeah. It really is. And there's one section here I want to make sure we don't miss.
Okay, what's that?
It's titled RVCC Parameters.
Ah, yeah, this is interesting stuff.
But I'll be honest, I'm not exactly sure what RVCC stands for.
So RVCC stands for Rebalance Volatility Certification Course.
Okay, so it's like their own program.
Yeah, it's a program they offer.
Yeah.
And these RVCC parameters are some of their key metrics.
Got it. So these are the things that they really pay attention to when they're analyzing the market.
Exactly.
Okay, well, let's break it down then.
Yeah.
We've got PE, PB, MG, RSI. It's another one of those alphabet soup situations.
It is, but we can demystify these acronyms.
Let's do it.
So we already talked about PE, the price-to-earnings ratio.
Right, right.
Next up is PB, which stands for price-to-book ratio.
Okay, and what does that tell us?
This compares a company's stock price to its book value, which is essentially the net value of its assets.
Okay, so it's like, how much is the company really worth on paper?
Exactly. And a lower PB ratio could suggest that a stock is undervalued.
Oh, interesting.
But of course, you always need to dig a little deeper.
Right. One number doesn't tell the whole story.
Exactly. Now, how about MG? Any guesses what that might be?
MG. I'm going to take a wild guess and say it has something to do with market cap.
You got it. MG likely refers to the market capitalization to GDP ratio.
Oh, right. That's similar to the Buffett indicator we talked about earlier.
You're catching on. It compares the overall size of the stock market to the country's economic output.
Right. So if the MG ratio is really high, that could be a sign that the market is overvalued.
Precisely. And on the flip side, a lower MG ratio might suggest the market is undervalued.
Okay, so it's all about relative value.
Always. Now let's move on to RSI, which stands for the Relative Strength Index.
RSI, okay, I've heard of that one, but remind me what it measures.
It's a momentum indicator, so it looks at the size of recent price changes to try to figure out if a stock is overbought or oversold.
Okay, so it can kind of give you a clue about whether a stock's price has moved too far, too fast?
Exactly. Think of it like a warning signal.
Interesting. Okay, what about FII, net open interest? What's that all about?
So FII stands for Foreign Institutional Investors, those big players like pension funds and hedge funds that invest internationally.
Right, the big money.
Exactly. And net open interest refers to the total number of outstanding derivative contracts like futures and options held by FIIs.
Okay, so it basically tells us how much these big institutions are betting on the India market.
That's a good way to put it. It gives us a glimpse into their trading activity and their overall sentiment.
So if FII net open interest is positive, that's usually a good sign.
Generally, yes. It means FIIs are net buyers of Indian stocks and derivatives.
Okay, so keeping an eye on those FII numbers can give us some clues about how foreign investors are feeling.
Absolutely. They can have a big influence on the market.
Okay, I think we've covered most of those RVCC parameters, but there's one more I'm curious about.
Which one is that?
The VIX. What does that tell us?
The VIX. It's often called the fear index because it measures market volatility.
Okay, so how much prices are expected to swing up and down?
You got it. A higher VIX usually indicates more fear and uncertainty among investors.
So a high VIX is like a roller coaster, and low VIX is more like a calm boat ride.
That's a great analogy. And according to this newsletter, the VIX went from 15.75 on January 19th to 18.13 on January 26th.
So a bit of an increase. Does that mean investors are getting a little bit more nervous?
It could suggest that, but it's important to look at the broader context.
Right. One data point doesn't tell the whole story.
Exactly. You always have to consider the bigger picture.
Okay, well, let's move on to another section that I found interesting.
Okay, which one?
It's titled Notes and Observations Below 23,000 Nifty Level.
Ah, yes. This is where they start giving specific investment advice.
Right, and it looks like their recommendations are based on different Nifty levels.
That's right. It's all about those levels.
So what are they suggesting for Nifty levels below 23,000?
They recommend converting all debt to equity.
Okay, so basically moving your money out of things like bonds and into stocks.
Exactly. They seem to believe that the potential returns from equities outweigh the risks at that level.
Interesting. And what if the Nifty drops even further? They have a separate note for levels below 22,000, right?
They do, and that's where it gets really bold.
What do they say?
They suggest buying even more equity and even converting assets like gold and fixed deposits into equities.
Wow, so they're really doubling down at that point.
It seems so. They see some serious buying opportunities at those lower levels.
But again, we have to emphasize that this is just one perspective, and it's important for each investor to do their own research and consider their own risk tolerance.
Couldn't agree more. Blindly following any advice, even from experts, can be risky.
Exactly. Investing is a personal journey.
Absolutely. There's no magic formula that works for everyone.
Now, the newsletter also talks about some of the same trends we discussed earlier, those large cap and momentum funds, and those favored sectors. Banking, finance, IT, and pharma.
Right. It seems like they're really bullish on those areas.
Yeah, but I'm curious, do they give any specific reasons why they're highlighting these sectors?
Unfortunately, they don't go into a lot of detail.
Oh, okay.
But we can make some educated guesses based on what we know about the Indian market.
Okay, yeah, let's hear it.
For instance, the banking and finance sector is often a good indicator of the overall health of the economy.
Makes sense.
And India has a lot of growth potential, which could lead to more lending activity and financial transactions.
Right, more money flowing around.
Exactly. And as for IT and pharma, we already talked about how India has become a global leader in those areas.
Yeah, so those sectors are definitely attracting attention from investors worldwide.
They are, but again, it's crucial for each listener to consider whether these sectors align with their own investment goals and strategy.
Okay, so do your research and make sure it fits into your overall plan.
Exactly. Now, there's one more section of this newsletter that I want to make sure we have time to cover.
What's that?
It's the equity neutral or negative or positive section, where they chart the market trends from 2022 to 2025.
Oh yeah, that historical overview. It looks super helpful.
It really is. It gives us a sense of how the market has been performing over the past few years and helps us understand its cyclical nature.
Okay, so let's dive into this timeline.
Let's do it.
Welcome back to our deep dive. You know, we've been looking at this market red alert analysis and this really in-depth newsletter from the volatility coaches of India.
Yeah, lots to unpack.
And, you know, we've seen kind of mixed signals about the Indian stock market, some reasons to be concerned, some reasons to be optimistic.
Definitely.
So as we kind of wrap things up here, let's see what we can learn from all this.
Sounds good.
One of the things I found really interesting about this newsletter is that despite that initial market red alert, they seem to end on a pretty positive note.
Yeah, I noticed that too.
Especially about, you know, certain parts of the market.
Right.
They seem to be really bullish on the Nifty Small Cap 100 and the Nifty Mid Cap 150.
Yeah, those smaller companies.
So even though there's this kind of sense of caution in the air, what makes those smaller companies so appealing?
Well, smaller companies often have a lot more room to grow.
Okay.
They're not these big established companies that are already, you know, kind of at the top of their game.
Right.
So they have the potential to really outperform the larger companies during a market upswing.
So higher risk, but also potentially higher reward.
Exactly. They can be more volatile.
Okay.
But that volatility can work in your favor if you pick the right companies.
So for the listener, what's the takeaway here? Should they be shifting their focus to these smaller companies?
That's the million-dollar question, isn't it?
Right.
And unfortunately, there's no easy answer.
Right.
It really comes down to each individual investor's goals and risk tolerance.
Okay, so maybe not a one-size-fits-all approach?
Definitely not. You really need to think about your own personal situation.
Okay, and looking at this final RVCC parameters table that they've included, it really highlights how much variation there is between different sectors, doesn't it?
Absolutely. The PE ratios, for example, are all over the place.
Yeah, the Nifty 50, which tracks those large established companies, has a PE of 21.09.
Right.
But the Nifty Midcap 50 is way higher at 45.86.
Yeah, so investors are clearly expecting much faster growth from those mid-sized companies.
So even if the overall market seems, you know, expensive or cheap at first glance, you really need to look closely at specific sectors to understand what's going on.
It's all about nuance.
Right.
Not just looking at the big picture, but really digging into the details.
So as we wrap up this deep dive into the Indian stock market, what are some of the key things you, the listener, should keep in mind?
Well, first and foremost, remember that the market is always going to have its ups and downs.
Okay.
Don't panic when you see those headlines screaming, market red alert.
So don't make rash decisions based on, you know, fear or short-term fluctuations.
Exactly. Focus on understanding the data and the long-term trends.
What else?
Pay attention to those key indicators we've been talking about.
Okay.
Things like PE ratios, FDY levels, the VIX, those sector-specific trends.
Okay. Those can give you a much better understanding of what's really happening.
Exactly. They paint a more complete picture.
Any final words of wisdom for our listeners before we sign off?
Absolutely. And it's probably the most important one.
Yeah.
Don't blindly follow anyone's advice.
Okay.
Not even ours.
That's right.
Investing is a personal journey. What works for one person might be a disaster for another.
So do your own research, understand your own risk tolerance.
Exactly.
And, you know, if you need guidance, talk to a financial advisor who really understands your situation.
Couldn't have said it better myself.
Well, that wraps up our deep dive into the Indian stock market.
It was a good one.
We hope you found this exploration helpful. And remember, the more informed you are, the better decisions you can make.
That's what it's all about.
Until next time, happy investing.